You know, a trader doesn't really see the market for what it is until he's been knocked around a few times. At first, all you notice are prices, numbers flickering on a board, but after years in the tape, you start to catch something deeper. And right there is where today's idea really lies. It reminds me of something I mentioned in the previous video on 4 phases of market manipulation and how to spot them, because patterns only reveal themselves once you've lived through enough of them. The funny thing about time is that it doesn't just pass, it teaches. And in the markets, time is the most expensive teacher you'll ever hire. Have you ever noticed how certain movements only make sense in hindsight? How the same setup you ignored 5 years ago suddenly looks obvious after you've had enough losses, enough wins, and enough quiet moments staring at a chart thinking, why didn't I see this sooner? I had to learn it the same way every serious trader does, by paying tuition to the market. Not through books, not through theories, but through the hard, taught lessons of experience. And if you're listening to me now, you're already a few steps ahead, because you're starting to look beyond price and into behavior. That's where the real patterns hide, in the behavior of crowds, in the rhythm of their fear and their greed. Now, the time pattern I'm talking about isn't some secret formula. It's not a magic indicator. It's the tempo of the market. Markets don't move in straight lines. They move in cycles of pressure and release. They build energy, they pause, they shake you out, and then they move when the crowd least expects it. Have you noticed that? That little stall before the real move. That lull that makes you doubt your position right before the market starts doing exactly what it was prepared to do all along. After enough years, you start recognizing the rhythm the same way a sailor reads the tide. You don't force it. You wait for it. And while you're waiting, you're thinking, what is the crowd doing right now? What are they afraid of? What are they hoping for? Because the market runs on the combined hopes and fears of thousands of traders pressing their orders at the same time. Most people think this time pattern is about predicting the future. It isn't. It's about recognizing when the market is ready. It's about knowing when a move is mature enough to matter. You can read all the signals you want, but until you understand the clock inside the market, you'll always feel a step behind. And let me ask you something. Have you ever jumped into a trade too early because you thought you saw the move starting, only to watch price drift sideways for days, eating your patience and your capital? That's the penalty for trading without recognizing the market's timing. The tape never rushes for anyone. It moves in its own hour. The traders who survive long enough begin to respect that pace. They learn the difference between a market that's preparing and a market that's performing. Most beginners blur those two together, and they get chopped up because of it. They get shaken out right when the market is simply resting. They dive in right when the move is exhausted. That's why this particular pattern is only visible after years, because it's not a visual pattern, it's a mental one. You don't see it on the chart, you feel it in the preparation of price. The longer you trade, the more you notice that important moves don't happen instantly. They form like storms, slowly, subtly, often quietly. The market tips its hand long before the breakout, but you only notice it if you've seen that same setup mature 100 times before. And here's something worth remembering. You can't cheat time. You can't trade like a veteran in your first year. But you can shorten the learning curve by being honest with yourself. Most traders lie to themselves more than they lie to anyone else. They tell themselves a bad position is a good one. They convince themselves a losing trade is temporary. They look for certainty when the market only offers probabilities. Are you guilty of that too? When you stay in the game long enough, you start to see how the market manipulates impatience. That's why in the earlier video on the 4 phases of market manipulation and how to spot them, I talked about how the pros rely on your reactions, not your analysis. Well, this time pattern sits right inside that same idea. The market stretches time to test you. It delays just long enough for weak hands to fold, then it makes its true move. You begin to notice that the strongest positions you've ever held were the ones that tested your mental toughness before they rewarded you financially. That's not coincidence. That's the rhythm I'm talking about. The market waits until doubt reaches its peak, and then it rewards the trader who held through the pressure, not recklessly, but because the structure was still intact and the timing was still forming. Think about your best trade, not the biggest winner, but the best executed one. Didn't it feel like you were walking a tightrope between conviction and uncertainty? Didn't it test you before it paid you? That's the pattern. It's not the shape of the candles, it's the shape of the time between them. And as you internalize that, something shifts in your mindset. You stop trying to catch every move. You stop trying to predict outcomes and start recognizing conditions. You begin to wait like a hunter instead of chasing like a gambler. That's where wealth building truly begins, not in taking big risks, but in taking smart ones at the right moment. You start focusing on preservation first, accumulation second. You stop rushing entries and start letting setups mature. You stop leaving trades too early because you finally understand that a market needs time to breathe before it runs. And let me ask you, how many times have you cut your winners too soon because the market paused and you mistook the pause for a reversal? Every trader lives that mistake. The experienced trader learns from it. The veteran builds his rules around it. Because the real secret is this: the market rewards patience more than brilliance. But it takes years to believe that, and even longer to behave like you believe it. When traders first enter the market, they think everything important happens in the price. They watch for breakouts, plunges, reversals, and any sharp motion that looks like opportunity. But with time, and only with time, you start to realize the real story isn't in the movement, but in the maturity of the movement. Market moves don't simply appear. They develop. They ripen the way fruit ripens, following a pace that can't be forced, rushed, or shortened. You may not see this in your first year or your second, because in the beginning you're focused on the surface. But eventually you notice something that only years of screen time can reveal. The market has a natural tempo, a rhythm that shapes every major move long before it becomes visible to the crowd. Most people try to rely on indicators, patterns, news events, anything they can quantify. But the tempo I'm talking about isn't found in indicators. It's found in the behavior surrounding them. You start to notice how price behaves before it makes a decisive move. You notice how momentum builds in waves, not in straight lines. You see how the volume dries up at certain moments, not as a sign of weakness, but as a sign of waiting. Have you ever stared at a chart and felt that the market was coiling, even though you couldn't explain exactly why? That feeling isn't intuition. It's accumulated observation. It's years of watching similar structures play out until your mind recognizes the signature even before your analysis does. A market move that's truly ready has a particular character. The pullbacks become smaller, less violent. The volatility smooths out. Sellers lose enthusiasm, or buyers show determination, not through dramatic pushes but through subtle consistency. These things don't shout, they whisper. And when you're new, you don't listen for whispers. You listen for the loud moves, the big candles, the dramatic signals. But the veteran learns that by the time the move is loud, the real opportunity is mostly gone. There's another part to this tempo, the way time filters out the weak hands. The market will often pause at the most inconvenient moments. It will stall near a key level for far longer than you think is reasonable. It will edge sideways while fear creeps into the minds of impatient traders. And right there is where you see why timing matters. The move isn't mature yet. The market hasn't built enough energy. The late sellers haven't given up. The early buyers haven't been shaken out. Until that happens, the market isn't ready to do what the structure suggests. It's almost like watching a crowd hesitate before a decision. If you've seen enough crowds hesitate, you can feel when the hesitation is nearing its end. This is why traders often complain, "I was right, but I entered too early." They weren't wrong in direction. They were wrong in timing. They didn't understand the maturity of the move. They saw the setup, but not the readiness. They saw the signal, but not the rhythm. Have you ever experienced that? Being right eventually, but wrong at the exact moment you acted. That's the cost of ignoring the tempo. The longer you trade, the more sensitive you become to the market's internal rhythm. You start to wait for confirmation, not confirmation in price, but confirmation in behavior. You wait for the market to compress in a certain way. You wait for the liquidity to shift. You wait for the failed tests to reveal who's losing control. And you wait for the market to show that it has gathered the fuel it needs to travel. That fuel isn't money, it's imbalance. Imbalance takes time to form. It rarely forms during fast, frantic action. It forms during the quiet moments when pressure accumulates. This kind of awareness can't be taught in a strict mechanical sense. It grows from repetition, from watching enough consolidations to know the difference between a lazy drift and a true build-up, from seeing enough false starts to recognize when a market is merely teasing traders rather than preparing for a genuine move, and from studying enough failed moves to understand that early force doesn't mean sustained force. It's interesting how time changes your approach. In your early days, you're always eager to act. You think opportunity will disappear if you don't jump immediately. But with experience comes patience, the kind of patience that isn't passive, but strategic. You begin to let the market come to you. You wait for the setup to age the way a winemaker waits for a barrel to mature. You don't open the barrel early because you're thirsty. You open it when it's ready. You also learn that timing is deeply connected to crowd behavior. A price level might look good, but if the crowd hasn't been pressured yet, the move won't stick. That's another thing you only notice after enough years. You stop asking, "What should happen here?" and start asking, "Has the market prepared itself for what should happen?" Those are two different questions. One belongs to beginners. The other belongs to traders with experience. Eventually, you begin to see that the most profitable trades weren't only built on price. They were built on the space between the prices. They were built on the pauses, the waiting periods, the tests of patience, the subtle declines in enthusiasm from the opposing side. When all these conditions come together, the move becomes inevitable, not in a guaranteed sense, but in a structural sense. The maturity is there, the tempo is right, the move is prepared. Price action has a funny way of saying everything without saying it loudly. If you've traded long enough, you start noticing this strange, quiet habit the market has right before the big moves. It pauses. It hesitates. It drifts sideways in a way that feels almost intentional, like it's watching you, waiting to see what you'll do. At first glance, this pause looks meaningless, maybe even boring. But with enough years behind the screen, you realize those pauses are some of the most revealing moments in the entire trading cycle. And I'm sure you've felt it yourself. Those stretches where nothing seems to happen, and yet your nerves are more active than when the market is moving. This is where the real test of a trader's mindset sits. The price action pause becomes a mirror, reflecting your patience, your discipline, and your understanding of structure. Most beginners interpret the pause as indecision, or worse, a sign their idea is wrong. They jump out, cut the position, or hesitate to take it in the first place. But seasoned traders look at that same pause and recognize it as the coil before the strike. Have you ever closed a trade because the price stopped moving, only to watch it explode in the very direction you expected the moment you were out? That's the market exposing impatience. The irony is that these pauses aren't just delays. They're tests. They're like the market asking, do you actually understand what you're trading, or are you just reacting to motion? When price stalls, it's usually filtering out traders who only have conviction when the candles are fast and exciting. A strong trend doesn't start with excitement. It starts with tension. It starts with the crowd losing interest, losing confidence, or getting shaken out by the lack of progress. And right there, in the quiet moments, the foundation for the next major move is being built. Price pauses for structural reasons. It pauses when large participants accumulate positions quietly. It pauses when liquidity is being absorbed or transferred. It pauses when the market is deciding whether the current balance of buyers and sellers can support a new direction. These things take time. The market isn't a machine. It's a crowd, and crowds don't shift sentiment instantly. They shift slowly, subtly, step by step, until suddenly the pressure becomes too much and the market breaks out. During these pauses, the character of the price action tells you everything if you know what to watch for. You'll see the lows getting protected, even if barely. You'll see the highs being tested but not convincingly broken. You'll see volume dry up, or sometimes slightly increase, depending on what the move needs next. You'll see shallow pullbacks indicating that the opposing side is losing strength. And you'll see that the market is holding levels not because of luck, but because strength is quietly building beneath the surface. This is why traders who rely only on fast action struggle. They need confirmation in movement, but the market offers confirmation in behavior. That behavior becomes most visible right in the pause that so many traders dismiss. When you start recognizing that, you stop fearing the pause. You start studying it. It becomes your edge instead of your frustration. There's also a psychological layer that's easy to overlook. A pause in price forces traders to confront uncertainty. When price is moving fast, your emotions get drowned out by the excitement. But when price sits still, your thoughts get louder. Doubt creeps in. You start wondering if you misread the chart. You check news, indicators, opinions, anything to soothe the discomfort of inactivity. And while you're doing that, the market is watching to see who breaks first, you or the price level. Ask yourself, how many times have you talked yourself out of a perfectly valid trade simply because the market didn't move fast enough? How many opportunities slipped away not because the analysis was wrong, but because the timing didn't match your emotional tolerance? This is why veteran traders often appear calm in moments when beginners feel lost. They've lived through enough of these pauses to understand they're not random. They're part of how markets build momentum. A market rarely launches straight from a level without first shaking out the early entries. If it did, everyone would win, and that's not how markets work. The pause is almost a cleansing period, clearing the board of traders who are too early, too eager, or too unsure. Another aspect worth noticing is that every significant move has a breathing pattern. The market inhales before it exhales. The inhale is the pause, the tightening, the compression, the subtle leaning in one direction. Only when the lungs are full, metaphorically speaking, does the market release the energy. If you try to force the move before that inhale completes, you end up fighting the natural ebb and flow of price. That's how traders get chopped up. As your experience grows, you start recognizing the internal rhythm of the pause. You learn to read the difference between a healthy consolidation and a structure that's collapsing. You learn to tell when the market is stalling because it's preparing, versus when it's stalling because it's lost conviction. This distinction doesn't come from any single indicator. It comes from seeing price behave the same way hundreds of times and finally understanding what it was showing you all along. And eventually, you realize something you didn't grasp in the beginning. The pause isn't the absence of movement. It is movement. It's the internal movement of participants adjusting their expectations, shifting positions, and preparing for what comes next. The market doesn't sprint without stretching first. It doesn't break without tension. It doesn't trend without shaking out those who can't sit through stillness. Every trader remembers the first time they held a position that felt completely wrong, only to watch it turn into one of their strongest trades. It's almost a rite of passage in this business. You place a trade based on your analysis. Everything looks sound, the structure is there, the logic holds, and then the market seems to test your every nerve. Price pulls back a little too far, lingers a little too long, or moves in a way that makes you start questioning yourself. And right when it feels most uncomfortable, when you're closest to closing the trade out of pure emotional pressure, the market finally moves in your direction with purpose. Have you ever experienced that sharp twist in your gut right before you were proven right? That discomfort isn't accidental. It's built into the nature of trading. Strong trades often come wrapped in uncertainty because the market rarely rewards the obvious. If a setup feels too easy, too clean, too painless, chances are it's already crowded. When a move becomes obvious to the masses, the edge begins to disappear. But when a setup tests you, when it forces you to stay committed, despite a bit of turbulence, that's often the sign you're positioned ahead of the crowd, and being ahead of the crowd never feels comfortable. Think about how price behaves around meaningful levels. It almost always challenges traders before revealing its true direction. The market dips just a little lower to trigger stop losses. It spikes just a little higher to bait breakout chasers. It wobbles in a way that shakes weak hands loose. This isn't personal, it's structural. The market needs liquidity to move, and one of the easiest ways to create liquidity is by making good positions feel wrong long enough for the inexperienced to exit. The uncomfortable feeling isn't a flaw in your psychology. It's a signal that you might be seeing something others haven't accepted yet. But this doesn't mean discomfort equals profit. You can't rely on discomfort alone. What makes a strong trade feel uncomfortable in the first place is the tension between solid analysis and temporary market noise. You know the structure is intact. You know the reasoning is sound. Yet the price action refuses to give you instant confirmation. That gap between logic and movement creates emotional friction. And that friction is what forces you to grow as a trader. A lot of beginners think good trades should feel good from the start. They expect instant validation. They expect price to immediately reward them. But that's a gambler's expectation. Markets don't pay out on demand. They pay out when timing, structure, and sentiment align, usually after testing the resolve of anyone who didn't truly believe in their setup. Have you noticed how the trades that instantly run in your favor often fizzle out just as quickly? Quick validation can be deceptive. It feels pleasant, but it doesn't necessarily signal strength. On the other hand, the strongest trades often start with resistance, not from the market, but from your own emotions. You enter a position, and instead of shooting up, the price stays quiet. It flickers, dips, hesitates. Your mind begins to whisper doubts. Then the market moves slightly against you, not enough to invalidate the setup, but enough to make you question your conviction. This is the moment many traders bail. They cut the trade too soon, not because the setup is wrong, but because they're uncomfortable. The market's job is to separate the confident from the inconsistent, and discomfort is often the tool it uses. What's fascinating is that this discomfort becomes easier to read with experience. You start distinguishing between healthy discomfort and warning discomfort. Healthy discomfort is the tension that comes from holding a valid position during natural fluctuations. Warning discomfort is the feeling you get when the structure is breaking down, when price is violating levels it shouldn't violate. The difference isn't purely emotional, it's behavioral. And learning to tell them apart is one of the skills that takes a trader from average to disciplined. For example, in strong trades, the market might move against you briefly, but the movement is controlled, orderly, and lacking conviction. The counter move doesn't expand aggressively. The volume doesn't spike in a worrying way. The level that matters remains protected. The pullbacks are shallow or slow. You feel the discomfort, but you also notice the underlying strength. It's like watching a storm cloud passing. It's threatening, yes, but the foundation of your setup remains solid. Weak trades, however, feel wrong in a different way. The market pushes against your position with force. Levels break without hesitation. The behavior shifts in a way that contradicts your premise. The market is telling you something, not testing you. The discomfort is sharper, more urgent. This is the kind of discomfort that demands action, not patience. Learning this distinction comes only with time. No indicator can teach it. No book can explain it fully. You have to feel it over many trades, many cycles, many mistakes. Over time, the discomfort stops being a threat and becomes a message. It becomes a cue. It becomes part of your edge. And there's one more truth about this principle that traders eventually learn. The market often rewards those willing to sit through the discomfort because so few are willing to do it. The crowd wants comfort. They want reassurance. They want certainty. But certainty shows up too late in trading. By the time a trade feels good to everyone, the profit potential has already been squeezed out. If you think back to your best trades, the ones you executed well, the ones that paid you cleanly. You'll notice how many of them carried a moment of doubt right before they took off. The discomfort didn't mean the trade was wrong. It meant the market was in its preparation phase, clearing the path before the real move began. And once you recognize this pattern, you begin to see that the discomfort attached to strong trades isn't something to fear, it's something to respect. When you watch the market long enough, you realize that the moves people call sudden were never truly sudden. They were only sudden to those who weren't paying attention to the preparation. That's something you learn after thousands of hours staring at charts. The strongest, most meaningful market moves don't just appear out of thin air. They build slowly, quietly, almost invisibly to the untrained eye. They gather fuel long before they ignite, and that fuel is made up of structure, sentiment, liquidity, and pressure. If you look closely, you start seeing the groundwork forming well ahead of time, almost like the market is laying bricks for a road it plans to travel on later. Most new traders don't notice this. They only react to the breakout, the big candle, the explosion, the moment the crowd wakes up. But by the time the crowd wakes up, the move is already halfway over. The real opportunity sits in the preparation, not the fireworks. Have you ever seen price explode in a direction and thought, I knew it looked like something was forming there. I just didn't act on it. That hesitation comes from not trusting the preparation phase. Most beginners don't understand it, so they ignore it. But that phase is where professionals mark their spots. The preparation shows itself in subtle ways. Price starts respecting certain levels with unusual consistency. Lows become harder to break. Highs start forming tighter ranges. Volume behaves differently. Sometimes it dries up, sometimes it grows in controlled bursts. Liquidity pools get probed but not fully taken. You see these little hints if you're paying attention, but they're quiet. They don't shout, they whisper. And most traders aren't trained to listen to whispers. Sudden spikes, on the other hand, are dramatic but unreliable. They're emotional. They're sparked by news, by panic, by short-term imbalances. They don't signify intention. They don't show commitment. They're like a match flaring, bright, but fleeting. If you chase them, the market often punishes you. You get trapped in a move that had no foundation, no structure, nothing to sustain it once the initial energy fades. And when the spike collapses, you realize too late that what looked like momentum was really just noise. The sustained preparation, however, is like pressure building in a sealed chamber. The longer the market holds a level without breaking, the more energy accumulates. The more failed attempts you see on one side, the more likely the opposite side will eventually overpower it. And when that release happens, it's not a chaotic spike. It's a meaningful push. It's a move backed by structure, sentiment, and real positioning. Experienced traders aren't surprised by these moves. They've been waiting for them, quietly, while the inexperienced get caught off guard. You can see preparation in the way price consolidates. Consolidation isn't stagnation, it's construction. It's the market gathering resources. It's participants jostling for position, transferring inventory from weak hands to strong hands. When price moves sideways for longer than seems reasonable, it's often not because the market is confused. It's because the market is organizing. It's aligning the pieces for the next leg. Ask yourself, how many times have you avoided a setup because the market looked boring, only to watch it break decisively in the exact direction the structure hinted at? Another sign of preparation is the presence of repeated rejections without follow-through. When the market tests a level 3, 4, 5 times without breaking it, that's information. It tells you which side is defending and which side is losing ground. These repeated tests create pressure. Each attempt weakens the defense until finally the imbalance reaches its tipping point. And when that moment arrives, the move that follows looks powerful, but it isn't sudden. It's the release of built-up intent. This is why seasoned traders don't chase moves. They position themselves during the preparation. They watch how price behaves around liquidity. They watch how sentiment shifts. They watch how the tape slows down or speeds up. They look for the footprints of large participants quietly loading up. These clues never come in the form of huge spikes. They come as a series of controlled behaviors that, when put together, form a clear narrative. You also start to recognize that when the market prepares for a move, it often tries to disguise its intentions. It creates small traps, fake breakouts, minor manipulations to shake out early entries. These traps aren't random. They're part of the preparation. The market wants commitment from strong hands and fear from weak ones. It can't move powerfully until the weak hands have been cleared out, and clearing them out takes time. This is where patience becomes an edge. If you don't understand preparation, you'll always be reacting. You'll always enter late, exit early, and feel like the market is one step ahead of you. But once you learn to see the groundwork, you stop feeling rushed. You stop relying on adrenaline. You stop needing the dramatic confirmation. You learn to wait for the setup to mature, because you've seen enough cycles to know that real moves don't need to surprise you. They need to prepare first. And when you finally catch one of those prepared moves, it feels different.